The global economy is weak while the markets are strong. Is the financial system reaching an unstable equilibrium? And would you say this will end in tears?
Funny that you say that because people are crying anytime they listen to the economy or politics today. So I think the disconnection between stock and bond markets and fundamentals is due to abundant macro liquidity and repeated central bank intervention. After years of complacency, data signal risks ahead across the world. Growth is slowing. Leading indicators point to a mild global recession, I would think even more so, that are going to be driven by the EM slowdown. Volatility and financial stress are going up, and macro liquidity is not translating into consistent market liquidity. So what we're looking is policy interventions that are being unlikely to be effective. In this context, central banks risk making policy mistakes and eventually losing credibility with the people. The recent episode of market volatility was an early warning when the central banks start tightening. A bear market correction will take place, and the asset prices will most likely decline to match the fundamentals. What does this mean? Capital preservation via a defensive asset allocation is the priority. Yet, unusual portfolios that are less liquid and more volatile are likely to perform better than conventional ones. There's another way of looking at this. So, are investment returns likely to be lower than in recent years or not? Not necessarily, because the trade off between sustained growth and financial stability is likely to continue. Buoyant volatility, which means that on paper, financial markets should favor with the orderly functioning of transnational financial flows, sustainable growth, and financial stability. So, over the past few years, however, economic growth could only be achieved via the buildup of debt and asset bubbles. So we hear about the tech bubble, the real estate bubble. This is likely to continue in bond markets. And the regulators in bond markets are going to try and force institutional investors to invest in AAA assets while the supply of these assets have already declined by 50%. We can see this in the quarterly reports of the third quarter of this year, where the yields on sovereign and corporate bonds which pay a spread over government debt, have gone down in tandem. So ultimately, the quest for financial safety has brought about severe safe asset shortages and eventually deficits in aggregate demand. Conversely, if the equity markets historically low real interest rates have pushed these asset prices high and created asset bubbles, which is what we're looking at, that will eventually boost investor returns via capital gains.